Good evening, everyone. My name is Michael Clemens. I'm the Director of II Research in Japan. And today we're hosting a speaker series for 2022. It's been long overdue. We have, I think, exhausted both the E, the S, and the G, and we've looked at it from many different angles. I'm not really back from ESG rehab, but I'm kind of on an ESG diet as far as what I'm reading and what we're talking about. But we're very happy today to have Stephen Givens joining us, as well as Dr. Kim Schumacher. So Stephen has spoken with us many times before, including our award ceremony. He's been in Japan, I think, raised and educated in Tokyo. He has his own practice where he is advising on both foreign firms and institutional investors on shareholder proposals, etc. And then Dr. Kim Schumacher is a lecturer for sustainable finance and ESG at the Tokyo Institute of Technology. So I think if there's two people that have a lot to say on this subject, I'm not sure if it's the same side of the subject, but certainly an interesting perspective. So I welcome you both. Why don't we start with you, Stephen, because you recently wrote an article that Japanese companies are pivoting away from ESG. And that seems to be contrarian to most things people are saying. If anything, there's just a deluge of information on LinkedIn and everybody's, I think, jumping on the ESG wagon, if you will. But on the flip side, I wouldn't say that I have any IR departments that are feeling anybody's wanting to hear about it. And even though we cover it at II in our surveys, I'm not sure if people know what to do with the data going forward. But what is your view on the subject?
Okay. Well, first of all, let me just give you the perspective that I bring, which is having worked for a long time as a corporate lawyer, but for the last 15 years advising a variety of foreign funds and so-called activist shareholder engagements with Japanese target companies. And in that context of ES and G, G is the one that I care about most and know about most. And I think that as we go through my presentation, one of the things that I think is a theme that we should be thinking about is that the E and S, on the one hand, are in fact in conflict with G. And I have been worried in advising foreign funds here that are trying to improve governance, that Japanese target companies often use the E and the S as a shield. And that's why I have, over the years, been interested in the whole phenomenon of Japanese companies embracing the ESG, SDG ideology. What's happened outside Japan very recently with a backlash that has emerged really quite quickly against ESG is something that has not quite reached the shores of Japan, but I think will. What's going on with the backlash against ESG is a very complex, very Western phenomenon that has to do with current debate about globalization. There's a sort of right and left political element to it. In the United States, attorneys general from the red states are basically bringing lawsuits against BlackRock and others, saying that it's not legitimate to invest the money of state pensioners or the state employees that are depending on returns. The whole notion of woke capitalism, that they're all kind of interconnected. The war in Ukraine, the energy crunch, the fact that gasoline is so expensive, people suddenly are questioning, I think, whether ESG as a political phenomenon is one that's really legitimate. And in the United States, this guy on the left, Aswath Damodaran, has written a series of papers that I believe very successfully dismantle the intellectual framework of ESG and persuasively says that it's basically intellectually incoherent. And others like Elon Musk have stepped in. There is this rising chorus against ESG outside of Japan in a very, very Western kind of context. In Japan, starting in 2015, ESG, and I think probably more than ESG in Japan has been SDG, have been warmly embraced by the major companies in Japan. And if you go look at the IR websites, or the websites in general, it is de rigueur that a Japanese company have something devoted to SDG, sustainable, whatever. And my read is that Japan has never really bought into ESG, SDG ideologically in the same way people outside of Japan in the West have. ESG, SDG have been attractive to Japanese corporations because it reverberates with the sort of quasi-socialistic, stakeholder-oriented vision of Japanese capitalism, for which has been around for a long time. But even before ESG and SDG talked about multiple stakeholders, proponents of Japanese capitalism in Japan have always talked about Japan is different because it puts people above profits. One of the things that I've encountered very much in my role as advisor to foreign funds trying to achieve better governance and better performance is that there seems to be a positive correlation between bad performance and lots of propaganda about SDG. I think it would be interesting to do a study of the correlation between, for example, a company's ROE and number of pages devoted to SDG. I think the lower the ROE, the more propaganda about SDG. There has been very little rigorous analysis or debate, as there has been now increasingly outside the United States, about the intellectual foundations, the intellectual integrity of SDG. But that's not surprising because Japan is simply not a country where people are that intellectual. People are much more comfortable doing things without a self-conscious kind of analysis. But at the same time, I think that there are very few people at the top levels of Japanese companies. There are very few Keidanren companies where there are true believers who believe that ESG and SDG are really important. It's done kind of as window dressing. It is done because foreign institutional investors of a certain kind, the Norwegian sovereign fund, expect it. And because it's expected, they do it. But I think that their heart has never really been in it. And Michael, you talked about the article that I wrote. Though the one thing that I noticed was the pushback from GPIF, from the just recently resigned former chairman Hirano back in, I believe, July of 2020, just after the guy whose picture is here, Hiromichi Mizuno, left after 5 years as CIO of GPF, during which time he advocated in a very aggressive way GPIF investing in ESG investments. And by the time that Hirano had made his comments, Mizuno had left and was briefly an advisor to METI, and then is now, I think, a director at Tesla, Danone. He has now gone on to bigger and better things as a continuing ESG proponent. But what Hirano has said, and what GPIF's propaganda has said very carefully following Mizuno's exit, is to say that the capital of Japan's pensioners, GPIF's beneficiaries, will not be used to further social or political goals. That ESG is legitimate only to the extent that it enhances returns. ESG itself is not a goal. It is a tool or means of achieving higher returns. And as the work of people like Aswath Damdran have shown, that as an empirical matter is actually a very hard, if not impossible, conclusion to make based on the actual empirical evidence. So I think that GPIF is kind of in a logical conundrum, because they have said very clearly that ESG goals in and of themselves are not legitimate goals. ESG is good only to the extent that it is a means to the end of higher returns. The empirical evidence is that ESG, in fact, does not lead to higher returns. And when that empirical evidence becomes clear, what does GPIF do? I think that it means that it is going to have to retreat. And BlackRock has been a proponent, as you know, until recently anyway, of ESG worldwide. And I think it's interesting that in the ESG shareholder proposals that have been made last year and this year, there was one made last year to Mizuho Financial. There were about 4 or 5 made this year to Mitsubishi Corporation and a number of others. BlackRock voted against those climate shareholder proposals right down the road. And I think that that really reflects the fact that in Japan, BlackRock is conscious that to take too aggressive an ESG profile is going to risk their business. And then finally, I think, and this is something that I alluded to a minute ago, GPIF and Japan as a whole has to really start thinking about, are the ES of ESG really consistent with the G? G is supposed to be the principles of corporate law that align the interests of managers with the goal of corporate value, or to put it more bluntly, to improve the value of the investment of shareholders. And as a shareholder governance is properly understood, I believe, a shareholder-centric concept, not a stakeholder centered, focused concept. So if I'm right that Japan is going to pivot away, is in fact right now pivoting away from ESG SDG, I don't think that there's going to be a magical road to Damascus moment when people say, oh, we were wrong all along. I think that there will be a characteristically Japanese, pragmatic, non-ideological, incremental retreat, and we will hear less and less about ESG and SDG over time. Those who are not familiar with Japan, I think, need to keep in mind that this is probably the least ideological nation of any I know. When you look at Japanese politics over the years, including the current administration, it's very hard to distinguish, actually, in terms of political ideology, how they differ. It's all very different, very subtly different flavors of the same basic menu. Kishida talks about a new form of capitalism that sounds kind of socialistic, but when you actually look at what it is, it's very incremental shifting of wealth and tax burden between different classes in Japan, and that's about it. So going forward, I think what will be the drivers of Japan's moving away from ESG? I think one very important factor will be what happens outside of Japan, because Japan is a follower, not a leader. If and to the extent that ESG loses its charm and legitimacy outside of Japan, then Japan will retreat in the same way. Another very important factor for Japan is that, unlike the United States, it is totally energy dependent on foreign sources. And as a result, it has to be very pragmatic about its energy policy. And it's shown itself, in fact, to be very pragmatic. And you can see that in all kinds of data points. Toyota right now is pushing very hard against becoming carbon neutral and going fully electric as soon as on the accelerated schedule that the government so far has mandated. Japan is gearing up to go nuclear again. Japan is not able to cut its ties from Russian energy, despite the fact that Russia is not necessarily a good actor. But when you are dependent, you can't be on the moral high road all the time. Japanese petroleum companies, refining companies are trying to go green by spinning off and taking private some of their dirtier businesses. But really all that's accomplishing is taking out of the public markets into the private markets, the dirty businesses. And the shareholder activist climate proposals that I just mentioned, I think it's worth noting that the one 1 year ago got 34% approval. The ones this year got much less. And when you look at the Japanese asset managers and the foreign asset managers, including BlackRock, how they voted, I think it was very clear that those proposals didn't get very much support. And then again, to return to the G, I really think that the E and the S pull against the G. What's important for Japan is the G. And the sooner that there is a clear, logical analysis of how those three things actually are good for companies, good for shareholders, good for Japan, the better Japan will be off. The final slide that I have is purely serendipitous, and I have no idea whether the trend here is how it's going to go. I tend to think, and to tell you that this is Google hits on the search term ESG toshi, ESG investment, starting at nothing in 2015, climbing up and peaking about a year ago, and going down since then. And my fearless prediction is that we saw the high tide of ESG toshi in Japan about a year ago, and that there will be a gradual decline over the next 2 or 3 years. And so with that, I wrap up my comments. I'm sorry if anybody's offended. That's it.
Okay, thank you very much. So Kim, you've had a very long career, and I think you're considered one of the ESG experts in Japan, certainly by us. I mean, what do you feel is the current state of affairs, or what's frustrating you? What's motivating you in this space?
Can I share my screen? I actually do.
Sure.
I'll stop my share.
So when I go back, in my own view, and we talked a little bit about this, Stephen, where I said I felt that ESG was more born closer to the time of the subprime and Lehman shock, but that you felt it really goes back to Milton Friedman and the fundamental concept around CSR even, and the fundamental goal of each company is to make a profit.
Yeah, I think that reflects the fact that I'm older than you, so I remember back to
which surprised me, but yes. So, I mean, certainly we still have CSR in companies, and I think that it's interesting to me that it doesn't mean probably what Milton Friedman felt it meant in those days, and it's moved on to even CSV, and now we've got ESG, and so it's almost interesting how it's kind of evolved into different spaces. And I think Kim's got his presentation up, but I'm just wondering, is this just a framework for people to be talking about the same things?
I think so. Any philosophy that says that the objective of a corporation, which is a financing device after all, is not only to maximize return for investors, but is something else. That maximum return for investors ought to be subordinated to other goals, and what those other goals are may change. But once you do that, you have broken a central cardinal rule of capitalism and the free market.
So Kim, you've got your presentation up there.
Yeah. So I think it will go a little bit into what Stephen said. So there's this feeling like it was pursued aggressively, ESG in Japan, but I also do think that right now we see like realignment, and I think we see a realignment rather in terms of allocation, as at the asset level, but we do not necessarily see it in terms of how Japanese companies and also Japanese funds are marketing themselves. So I think that is where increasingly there is a disconnect. We want to seize these opportunities with the overall ESG trends, despite there being pushback from in the United States from the various governors in certain states against ESG. What is it? West Virginia, Texas, among others that now implemented. Missouri, I think, also that implemented, I guess, some of the rules that whoever deals with funds that exclude certain sectors shall not the state shall not be doing any deals with them or engaging with them. But in Japan, I think it's a little bit they want to have their cake and eat it too. So sort of go a more traditional conventional route in terms of asset allocation, and also in terms of not restricting the investment universe. But on the other hand, they still want to sort of ride the ESG and sustainable investment train to the extent that they also keep pushing the SDGs and the SDG pin. So I think it's just another another one of those CSR SDGs that now ESG is the next thing. And I think that is reflective of what has been happening. And also I think greenwashing plays into that. Because my slides are they go a little bit beyond Japan. So I'm actually moving around maybe a visiting lecturer at the Tokyo Institute of Technology, but since August this year, I'm an associate professor at Kyushu University, but it's still sustainable finance and ESG. So we see, of course, globally, volumes are going up, and the number also of funds and assets under management is going up. And of course, Japan also wants to be part of that party, if you will. But of course, the majority is happening in Europe, and then a smaller volume, of course, in the United States with the aforementioned pushback. I also see that not necessarily significantly increasing over the coming years. But in Asia, there's a lot of potential. Where has it been going? Mostly health, renewable energy, food, agriculture, water sanitation, ecosystems, and biodiversity. But we see the overwhelming majority is going towards health. Of course, also with COVID, renewable energy, food, and agriculture. And why are we doing it? And that is where Stephen mentioned, the Friedmanian, mantra of shareholder value. And that is where actually research has found, and I wouldn't necessarily say that is the end of all research on this topic, but there's good evidence that those firms that do integrate ESG have shown stronger financial performance. And this is a meta study from 2015, conducted by researchers at the University of Hamburg in Germany, which analyzed more than 2,000 studies and 500 relevant studies around ESG integration. And he was not around that time. No, but environment, social, and governance considerations have been around for that long. So there has already been consideration around that. But even though there is proof that ESG does perform better, that does not mean that all funds do integrate ESG properly. And more and more, there's stories around what do these funds actually do deliver? Because on the one hand, you have financial performance, but on the other hand, you also have non-financial elements. And that is, I think, the thing that I am missing from the discussion a little bit right now is financial performance, yes, but the thing is also, it's just we do not really measure anything right now beyond financial performance, because we do measure it, but we do not measure it consistently. We do not measure it in a granular way. And those are some of the issues why funds now, step by step, especially those which advertise sustainability, are showing underperforming, because as we will see later, a lot of the funds that are sustainable funds or ESG funds actually are just being relabeled as such. And if you basically just take existing bottles with the same wine and you just relabel them, it remains the same wine. So not a lot is necessarily changing. So And that is one of the things why sustainable funds are seen as failing, because they're basically just existing regular funds. And so the performance is not outperforming as often they are not real. They are not funds right now are very rare. And often it's just a conventional fund that is now just operating under a different label. And that has been found in Switzerland and in Luxembourg for quite a lot of funds, also for some climate funds, has found which make environmental claims. And since we see that now, we see also the first casualties. So, example, Goldman Sachs is investigated by the SEC around a lack of accountability. And in Japan as well, the FSA is becoming a little bit more aware. A large fund has been investigated around its ESG labels. It was managed in the United States, in New York, but it was it was marketed and also sold by a large Japanese institution. And the problem with that is because the data is so bad in terms of actually assessing ESG properly, is that how we get different valuations and how we get widely different outcomes on ESG performance, depending on who do you use as your data provider. And it can sometimes be that companies are seen as very high performing in terms of ESG, or as very low performing on ESG, depending on what data provider you use. And that opens just the door for greenwashing, because you can just use a certain data provider and suddenly your fund looks all nice, but at the core nothing really changed because the data has just been interpreted differently. And because the data is so lacking, we get widely different portfolio holders. And if you have that, suddenly the notion of performance becomes very, very subjective, and it becomes also very more, difficult to make a real assessment whether a sustainable fund is overperforming or underperforming, because first of all, there's not enough data collected, and even the data that is collected is assessed in very different ways. So depending on how you look at it, it can be a success or it cannot be a success. So I think we cannot even answer the question right now, is ESG well performing or overperforming, or is it even underperforming? Because we do not even have the data to make that call right now. If anything that there is financial performance, then I would say we can also not say, because a lot of the sustainable funds are basically just regular funds under a new name. And these things fund managers struggle to compare ESG apples with oranges. It becomes very clear because they rely mostly on external data providers, because a lot of them are just not as knowledgeable in non-financial performance metrics like biodiversity, climate change, because they just rely on the data that they're getting. And as someone who is doing climate modeling, I can tell you it takes a lot of knowledge, and even climate models vary. So how would you even go with a more traditional financial background and with a capital assets performance model? How would you even go around looking at non-financial metrics and then put them in a financial valuation? So Elon Musk, of course, he's as Stephen mentioned, he showed his picture. He's of course chiming in, saying that ESG is a scam. Because Tesla did not perform well, but others did. But for Tesla, it was very interesting, and that's where methodology becomes very important. Some ESG data providers and ESG raters, they say Tesla only sells electric vehicles, so they are good. And then there's others who use a life cycle approach and say where do the materials for Tesla come from? How many Teslas drive in countries, and where does the electricity for those Teslas come from? And then also what happens with waste management after Tesla is is basically at the end of its lifetime. So there's a lot of questions, and depending on what methodology you use, you get widely differing outcomes. So with that, we see now that these ESG funds are popular, but they're rife with greenwashing because just there's so many ways of assessing them and evaluating their performance right now. And the EU has been trying to push against that with various rules, and also the regulators. So for example, the European Securities and Markets Authority sees that as a risk, for greenwashing, as you can see here. So greenwashing is just the process of conveying a false impression or providing misleading information about a company's products and services, and whether they are more environmentally sound or just in simple terms, do the claims match the evidence? And that is the thing. And also in terms of sustainable finance, it's greenwashing is the practice of marketing financial products as green or sustainable, when in fact they do not meet basic, and we get to Japan, when they do not meet basic environmental standards. And even ISO has a definition of greenwashing in the national space. So there is definitely a knowledge around greenwashing, and the SEC is now becoming more aware, and has also been charging first institutions with misstatements and omissions concerning ESG considerations. But also Japan is now, the FSA has already been sometimes cautioning certain fund providers around their ESG claims, but also has been going further with new measures around greenwashing. And results. So the Australian regulator has dished out its first fine for someone making misstatements. And that is where it's very important to know greenwashing in terms of in a Japanese context, if whether you want to assess whether ESG is a success or not, and why are they withdrawing. I'm saying nothing really changed, because ESG was just an illusion prior, and now it's just the clothes are off. So I do not think that much changed. It was just the advertisement changed, and now they're getting a little bit more cold feet because they see, hey, some regulators are now looking more closely, and we are held to a different standard, because the EU, for example, says you need to look not only at financial materiality, but also environmental and social materiality. And if you do not have that data, you cannot really market your product as a sustainable fund anymore. And you need to provide us with information around why you think your claims promote sustainability, and how do you bring the evidence for those claims. And that's where the EU now there's different categories, and other regulators are playing with the idea. The UK FCA has recently published very recent proposed rule, where it's also categorizing in three brackets, sustainable funds, and what kind of additionality do they bring. And now funds in the EU are asked to over the coming years to provide this information. How do your portfolio holdings perform in terms of greenhouse gas emissions, but also in terms of biodiversity sensitive areas? So I will not go too much. This is just a report. And in terms of disclosure, is Japan on the path to be aligned with those international requirements? Because the EU actually has an equivalence rule that says that those who market funds to EU customers have to provide this data also under the Sustainable Finance Disclosure Regulations. Will become very relevant for Japanese funds as well, if they want to. And currently we saw Japan is implementing some disclosure rules for companies, but in the international comparison that we found, Japan, at least in Asia, is not performing very well in terms of its disclosure stringency right now. So Japanese companies, they promote themselves as being very aligned with disclosure, but our results, our research did not find that. And this is a report that came out very recently. Together with Stanford, we wrote it. So the quick answer is, I don't think we can even tell, because either the data is not there, and right now we also find there's, due to the greenwashing and due to the fact that a lot of these funds have just been relabeled, and whether they provide any non-financial additionality in terms of, for example, lowering climate-related risks, or actually having a non-financial impact, we cannot say it. So in the sense, most sustainable funds are not sustainable funds, they're just regular funds. So the market has not been overperforming or underperforming, it's just been performing, because most of them are simply just sustainable funds or like regular funds with a green coat of paint. So, and that is what I would say is how I feel right now. Interesting to see what the others think about it, but I do not think there is no real ESG impact right now, because most funds have been relabeled, and those which do make claims, they're now being step by step found out that they cannot back up their claims. And that is where I see, no, ESG has not been underperforming or overperforming. We just do not know how it has been performing.
Right. So, I mean, the title of today's talk was, if not ESG, then what? And I, the other day I was at a client meeting, and on the way back, this elderly gentleman dropped his cane, and it was very of me to help him pick it up. But he was actually a retired executive from one of the trading companies and a professor at Scuba University lecturing on ESG. And just in the short time we were talking, he said, look, there was no G in Japan throughout the bubble. And the reality is Japan's kind of tried to catch up with regards to its concept of governance. However, the Japanese companies have a good example to European and even American companies on how to treat their employees. And so, I don't know how many people lost their job during COVID, for example, in Japan. So I think now it's become more of a global conversation. But if it is just a conversation, and just from your slides, you can see that the data is all over the place. I mean, do we keep pushing forward so that the data becomes regulated globally? Or if not, then what, I guess is my question. Because I think the question of governance is never going to go away. The question of how companies are affecting the environment is never going to go away. And every company really should be a socially minded company to begin with. But the harsh realities are, if they are just performing and the ultimate goal is to make a profit, I mean, then what, I guess, is still the question, if not ESG.
Well, the question, the thing is, if not ESG, then what? I think ESG is merely just a representation of, ideally, of a company lowering its risk exposure and also seizing new opportunities. So that would be the ideal. So on the other hand, I would say the fact that Japanese companies, how do I say, I would rather say Japan right now, that is my personal opinion, I think it's a death by 1,000 stings or 1,000 needles. It's slowly happening. It's not like, because Japan can still draw from a lot of value that has been created during the bubble time, during even previous years. So I think it will not happen overnight, but very interesting system that I always thought about was really important, and that is the thing with the key metrics. And previously there was the talk about some funds in Japan, ESG funds, or some funds that try to promote good governance, is the capacity for Japanese companies to implement change at the operational level and at the governance within its governance structures. And it was a statistic by the University of Tokyo where they basically said that between 2014 and 2020, they were only able to increase the share of female undergrads from 18.4 to 19.6. So they did not even cross the 20% threshold. And mind yourself, this is that's a university with a history of more than 100 years. So it's already not a good figure, but they even missed the target that they set themselves. And what I always think is, and that is very reflective also of large Japanese companies is, so the University of Tokyo is supposed to be the #1 university in Japan, and a lot of people in important positions in Japan have either been affiliated or have graduated, and the same goes for other universities. So especially public research universities. And the question is, like, yeah, so you haven't been able to increase your female student body by that amount. So that backs the question is, the smartest people are not able to figure out a way within 6 years to increase the share, like marginally over, like, yeah, to get it at least to 1/5, or there's much more deeper structural issues, and also the people in charge are not willing to make the very structural changes necessary to implement the change. So for me, as someone who also looks at ESG data, I do not care about how long their sustainability reporters. The University of Tokyo recently issued also a social bond. So I do not care about that. I will look at very key metrics. And some of the key metrics for me is, like, yeah, gender equality, female participation. And the other one is also internationalization, because it shows a deep willingness whether or not you're capable of change. That is not a statement on whether internationalization is good or bad. It just shows to me, are you capable of adapting structures within Japan? I'm not saying, like, yeah, going to buy on a buying spree outside of Japan. No, are you capable of within Japan to implement changes at the very fundamental governance structures and operational level that, like, yeah, reflect these ESG claims that you are making? Because that is the thing with greenwashing. If you're not promising anything, then you're also not really disappointing anyone. Then you're basically just doing that. But Japanese companies have been going, like, yeah, trying to oversell themselves with SDG and with ESG. So, and doing like a similar route. So, and if some core indicators show that very fundamental, like, yeah, like things that need to happen to change governance are not happening, and of course it is, then now we're just seeing, like, yeah, the result that the companies are pulling back from ESG because, like, yeah, they were not really ESG to begin with because the structures are not there to implement it. And I think that is where I see currently, if not ESG, then what? Then just, again, then we just replace ESG with BAU, business as usual.
Right.
That is what I would see.
So Stephen, I mean, is this just tatemae where the Japanese companies are just going to, tout ESG and SDGs until everyone goes away and changes the topic, or how do you see the future unfolding in this space?
I think it's always been tatemae. And what Kim has said, I think if a Japanese audience were to listen to him, would make them probably even more skeptical of ESG than they already are, because he, I think, is an ESG proponent, but he admits that the metrics so far are fake and wrong. But he sounds to me like a socialist who says, well, socialism has actually been tried in the world so far has not worked because the pure form of socialism has never been tried. And he seems to be saying ESG as practiced so far has been fake and wrong. But if we were only to practice ESG in a purer form, then we'd get closer to the real socialism. But I think that putting it in those terms, anybody listening would say, well, maybe someday in the future, but for the time being, ESG is something that I want to avoid. And the other thing that he and other proponents say, and it's really kind of a switch and bait, that I think it's important to point out, is on the one hand to say, we're doing this because ESG is a means to better return on investment. It's a way of lowering risk, but that the ultimate goal is to have the highest risk-adjusted investment return possible. But then he follows that up with the University of Tokyo example. The University of Tokyo is not a profit-making organization. And he says, what I really want to see is an ideological result of having women represented, without getting into whether that has academic merit, whether the fact is that Tokyo University, the exam is totally gender blind. And there are underlying reasons why boys, first of all, maybe take the exam in greater numbers than girls, but also the fact that they pass it in higher numbers because the entrance exam is highly math centered, and there's just some simple differences. So I think that that part of the logic exposes the fact that underlying it is an ideological thrust, not a technocratic, if we just do ESG, we'll get better risk-adjusted returns.
I would, the University of Tokyo example was rather, and everything that I said today was around the claims. What are you claiming you want to achieve? If the University of Tokyo sets itself a target that it sees as desirable, which is having a higher share of females, then I will measure them by that. I do not, they are free to do whatever they want. That is what are companies claiming? What are companies saying they want to do? So that is what I am measuring them against. I am not necessarily, and for me, you are conflating, or at least I think you're conflating sustainability and ESG. I'm not an ESG proponent in the sense, because again, I currently am not, because ESG does not exist in its current form, at least for what people who say they are integrating ESG try to do. So for me, it's not even a discussion whether or not I'm a proponent or I'm against it, because for me, again, it's similar to with sustainable funds. Currently, there are no sustainable funds. For me, it's always what is being claimed. What is it being marketed as? What are those who are trying to sell me these sustainable funds saying they can perform? So that is what I am not judging whatever. So that is maybe, I'm just looking at what did they say. If the company says we want to reach net zero by 2050, I would say, hey, that's not great. So you're going to and show me the. So that is the thing. I'm not ideologically driven. I basically from climate change and other resource issues, I see them happening, and companies will be affected by it, whether we want it or not. So I say what companies are doing a better job of limiting their risk, and also what short term, which is immediate financial risks, but also long term, which is what environmental and social materiality. So what would be the longer term implications? And if we're talking about pension funds, if I'm someone paying into a pension, I want to know in 40 years my money is safe. And in 40 years, that is a very different planet than right now. So those who are managing these funds, pension funds, and they are not fiduciaries only versus those who are getting their pension next year. They're also fiduciaries of those who will get their pension in 30 or 40 years. So I want to know that they take everything into account when they make asset allocation and when they do select from a different for certain holdings. I want to know that. So it's not ideologically driven. It's basically very at the core financially driven, because I want to know my returns are safe not only tomorrow, not only next week, but I want to know that for example, if I pay into a pension fund, that I have a pension in 40 years and not just so. And that is where I'm saying what is being promised. And if, again, the University of Tokyo or anyone promises me something, I want to know, how are they measuring progress? And how are they, providing me with the data so that I can see how well are they doing? And that is where I'm saying currently we do not have that. So I cannot really make an assessment whether or not it is successful or not. So I think like, yeah, there's those people, and that's also what the governors in the United States say for ESG is like, yeah, it's an ideology, it's wokeism under a different name. Not really. Like, yeah, there's people certainly who do that, but at the end of the day, for me, it's why should I support an investment strategy that is working against me in the long term? So, because again, pension funds are not only fiduciaries, or pension fund managers are not only fiduciaries towards like, yeah, those who get their pension next year. Again, they also need to manage and like, yeah, do investments accordingly so that it's still like, yeah, safe in 40, that it generates returns in 40 years. So, and that is where you can try to ignore some like, yeah, actually scientific realities that will occur, or that are highly likely to occur, or you can integrate them into your investment decision making. So that is where, and if that is, I think that shouldn't be ideological, but there's people who try to make it ideological.
Yeah. Well, I with due respect, if I were asked to analyze whether $1 million invested in Toyota or Tesla would do better over 40 years, the ESG factors would be very low down in what I look, the variables that I look on the analysis.
We saw the message from our colleague Amani, who covers European and Middle Eastern companies for us. And she points out how a lot of the corporates are putting a lot of resources in trying to navigate whatever the disclosure should be based on this poor data. So, you know, whether it's Tokyo University or the academics or government, I mean, who really will be driving this going forward as far as either having more uniformed data, or is it the underlying shareholders that will be driving this conversation? Because, you know, even when we go back to the slides that Kim showed earlier, where it's, you know, based on the European benchmark, it seems like Europe, at least collectively, have come up with whatever that benchmark should be, whilst the other Asian countries in comparison haven't met that. But I mean, is this going to be more policy driven from governments or academics, or is it really up to the money people, for lack of a better word, to help navigate this conversation going forward?
I think there's always this like, yeah, thing that everyone says the other one should do something. So
right,
before every COP, you always have like a letter from like, yeah, 250 company executives ask governments to do more. And then like, yeah, whenever more is on the table, they're like, oh no, we didn't really want you to do more. We just said you should do more. But like, yeah, that is what we said, but we don't want you to do that. So the thing is always like, yeah, as someone who invests, and I mentioned like, yeah, pension funds, but even me as an investor, and there's a clear like difference according to age. Young investors have very different expectations than older investors in terms of like, yeah, what they expect from their investments to do. And I was recently like, yeah, for me, if we talk and I want to minimize risk, and if I, for example, identify risk as like climate change as a risk, or other issues like nature-related risks as risks, then we also need to see what kind of influence do I have. And there's something very interesting that I thought recently with everyone has like been like, yeah, cheering for the for Lula da Silva, his victory in Brazil very recently, and said, oh, the Amazon is being saved. The thing is, what has not been so prominent is like, yeah, the steps that the Republicans in the United States have been taking to basically shield them from any accountability, and also how they try to politicize a lot of topics just to get like, yeah, if like, yeah, party A says A, then we have to say B, and then once party A says B, then we have to say A, and it's just like the diametrically the opposite. But the thing is, like, if, for example, companies do through funding, through lobbying, to whatever, have an influence on politics, then it should also be that investors say that companies need to lobby in a way that lowers risk. So, and that also then comes then, because politics does not operate in a vacuum. It does not operate or the politician can just do that. Why are they not So if there's no pressure from companies or from the financial sector in terms of implementing the policies that do lower risk, for example, lowering risk exposure in terms of, for example, coastal developments because of sea level rise, things like that. So if certain asset classes have a higher risk and also at the risk of stranded assets or devaluation, then it also becomes the obligation of investors, so the fiduciaries and trustees, to basically implement risk mitigation. That means engaging politics directly. So I think ultimately politics is just they are just executing at the end what society demands of them, and society includes also the financial sector and corporates.
We never go into overtime, so that we appreciate the passion from both sides on this topic. And I don't think there is a conclusion, to be frank. And I do, however, feel that this must be what the boards, which is probably what is going to be our next topic in the future, is struggling with, because they do have different generational investors. They have different people who are looking at investments, who are willing to forego costs in the name of climate, for example. And at the same time, I think they're struggling because, I think the real money people have lost faith in the regulators, which is why they've tried to package things into ESG or SDGs, etc. But ironically, it's probably those very same regulators or policymakers that need to come up with the benchmarks for everybody to be adhering to in order to understand which direction anybody should go. So that goes back to our probably next topic around the boards. And do you have ESG if the board is not behind it? Do you have governance if the board is not doing their fiduciary duty? And can they really navigate in today's world with all the different directions that people are looking at vis-a-vis ESG and all of the related topics, I think. But I do thank you both for joining today. And are there any final comments anyone would like to make, or any questions anybody has? Okay, so thank you very much for joining. That's our speaker series for 2022, and we look forward to talking to you both in the future. Thank you very much.